Time now for our ETF Spotlight. Mike Santoli is with us, keeping an eye, of course, today on bond ETFs.
Yeah, it's the obvious place to go. Obviously, the way that bond yields go up is the price of the bonds that are held by these ETFs go down. And if you look at some of these charts, it's pretty dramatic considering we're talking about Treasury securities underlying these funds. This is the TLT. This is very long-term Treasuries. I would point out this is not a very huge part of the overall Treasury market, even though it is kind of treated as a benchmark. That is down profoundly this year, and that looks like a pretty vulnerable chart still, at least from this glimpse, down almost 0.5% again today. You look at shorter maturities, it's really not much better. IEF is 7 to 10-year Treasuries, and you're going to see basically a similar angle held up somewhat better here, so it's preserved a little more of its value. And then finally, IEI is even shorter than that, so this is 3 to 7 year Treasury notes. And you know, the yields across the curve have been up quite a bit, and obviously that's hurted the values here. I did want to look at a much longer term view, though, of the AG, the AGG. That's the overall U.S. bond market index. If you look at a 10-year chart, you see we're right back to lows from early 2013. That was the taper tantrum. So obviously you've collected the interest payments along the way. This has done its job by more or less preserving value and being kind of some ballast in your portfolio. Total returns, though, for the AG, down 2.1% year to date. 1.6% on a one-year basis. So you're basically gone a year where you've lost on the bond side of your portfolio. On a 10-year basis, though, 3.5% annual total return. So it's done its job to this point. The question is what it does from here.
Yeah, the spike, although we talked about it all morning long, is not what we saw in the taper tantrum of 13, for example.
It's not.
Yeah.
It is not as steep or as sustained as that. I will say it's looking very extended on its chart, the yields. I mean, they probably should calm down pretty soon just based on the trading mechanics.
You've, this year, I think it's fair to say you've been willing to give the market the benefit of the doubt each time we've had a scare. Is it any different this time?
Not really. Not really. I think the market has to kind of make its peace with the yields at these levels. Every time you get to a new stage, you have to, essentially kind of come to terms with that and recalibrate valuations. It's definitely hurting on a sector basis, I think, some areas. Yeah. And it's just more raising concern about what 2019 holds, I think, if you're really going to get a squeeze.